For the next conversation, Lessons in Leadership, a peer-to-peer conversation, please welcome interviewer David Rubenstein, co-founder and co-chairman of the board, Carlyle, and Harvey Schwartz, CEO, Carlyle.
Okay. Wow. How many people here are in the financial service industry? Okay. How many are private equity investors? How many want to be private equity investors? Okay. And how many people here really don't know what they're doing here? They just for a free breakfast or something. Okay. Okay. So Harvey Schwartz is the CEO of Carlyle. And as some of you may know, he previously served as president of Goldman Sachs. He left Goldman Sachs and was recruited to be president of a CEO of Carlyle about 15 months ago or so. So Harvey, when you left Goldman Sachs, you could relax. You already went to the top of Wall Street. You're president of Goldman Sachs. Why would you want to give up sitting on the beach, being in New Jersey Shore, sitting on nonprofit boards to come back into the fray and be the CEO of a private equity firm? Why would you want to do that?
Well, first of all, it's great to be here, everybody, and thanks to Forbes for having us. This is not a body that really should be on the beach. Right. It's not a great visual for anyone, and I realized that pretty quickly after leaving Goldman. At Goldman, I had the privilege of committing a lot of capital to all the alternative firms, including Carlyle. So I knew the industry, I knew the firm, I knew the founders, I knew the iconic history of it, and I knew where the industry was headed in terms of capital flows, the role of private markets, and it was such a unique opportunity. I thought I would spare everybody the tan lines, and I made the leap. Okay, so when you were at Goldman, you rose up to be, I think Goldman had how many employees when you were there? 36,000. All right, so you rose up to be the co-president with David Solomon and the CFO as earlier and all that. Generally, my image of Goldman was that the people that rise up, or they went to Harvard, or they went to Yale, or they're Rhodes Scholars, or something like that. Did you have that kind of background? Definitively not. I was, by any standards, a poor performing high school student. I kind of barely got out of high school, and through a bunch of favors and friends, managed to get into Rutgers. Any people from New Jersey here? Go Jersey. And did you ever apply to college right out of high school? No. I mean, I don't want the whole group. How many are here? Like 1,000 people. I don't want the whole 1,000 people to go to like group therapy. But everybody's got their own complexities in their background. I grew up in a family where, quite sadly, both my parents suffered severe mental illness. My father suffered from schizophrenia, and my mother suffered what you would now call bipolar disorder. It was a tough environment. She passed away when I was young, and I kind of went off the rails. I didn't apply to any colleges, and then someone I guess you could refer to as a mentor, but really is more like an angel, intervened, encouraged me to apply to Rutgers. Was a Rutgers alumni, but not prestigious like you, not right. It doesn't really, not an influential, and I didn't get in. You didn't get in. It's hard to get in at Rutgers, right? It's harder now, and it was easier then, and I still couldn't do it. Right. And so it's quite an achievement. And then, but she intervened, and she called the university. Her name is Linda. We're still good friends. I owe her a lot, incredible debt of gratitude as Rutgers. She called Rutgers, and she said, you got to let this kid in. And they said, have him write a couple-page essay about why he did so poorly in high school, and we'll interview him, and they changed their mind. Amazing story. You got into Rutgers, you graduated from Rutgers, and you went to Harvard Business School? Immediately. No. I didn't know Harvard Business School really existed. First time I tried to get a job after Rutgers, I had an interview here on Wall Street, and I showed up, and I walked down Wall Street. I thought, wow, it's so small. I pictured it being much bigger. I didn't know Goldman Sachs existed. I know we have a lot of people here in the wealth side of the business. I'm just curious, show of hands, how many of you are either old enough or have had the joy of cold calling for a living? Just show of hands. Yeah, so when I graduated college in '87, cold calling wasn't illegal or restricted. So I took a job, most of you won't even know what this means, but you got paid $1,000 a month on a draw, which really meant there was a $1,000 loan. And I cold called, and my first day in the business actually was October 19th, 1987. I cold called 500 people that day. Nobody wanted to talk to me. If I was smart enough then, I would have known that was a sign. But eventually, through a lot of luck and a bit of hard work, I managed to find my way to Citibank and then eventually to Goldman Sachs. And now sitting here with you.
Okay, so now tell me, why should anybody want to invest in private equity today? Private credit gets a reasonably good return. Private equity, you tie up your money for 10 years and so. Returns are presumably coming down because interest rates are high. It's harder to buy things. Why should anybody want to invest in a private equity fund anymore?
So obviously, someone with my background, I've had an extraordinarily fortunate career in finance, but it's also a very interesting time frame to have been in finance, right? So I was born in 1964. I just turned 60. Kind of an amazing time, to be alive. And over that time period, David, as we all know, interest rates came down, regulation loosened, inflation came down. Geopolitically, the world got more cooperative, the Berlin Wall came down. This all created what I would refer to as a very frictionless or increasingly frictionless economic environment. And then you had the whole distortion of interest rates with monetary policy post-2008. And that took away even more friction. I think this point you're making about interest rates coming up now is really just the normalization of the cost of capital, which we haven't seen in many, many years. And that adjustment is such that as that cost of capital shifts up, it actually impacts every asset class, not just private equity. It impacts credit, all parts of private markets, venture capital, mortgages, home ownership. Everything around the world is adjusting to this very sudden 5% rise in interest rates. And I think all it means is risk-adjusted returns for every asset class have to shift. And so private equity at this particular point in time may not actually yield over the next 3, 5, 10 years increased returns, but I think on a risk-adjusted basis, they'll be better. There'll be more carve-outs, there'll be less leverage, there'll be more opportunities, just like you'll see across the whole private market spectrum.
All right, private equity firms have transformed themselves recently into private credit firms to some extent. All the large private equity firms, including Carlyle, have large private credit businesses. The people in large commercial banks say that's not fair because the private credit businesses aren't regulated the way the bank's lending operations are regulated. Is that a fair argument? And do you worry that there's going to be a big collapse of the private credit deals that all the private equity firms have been doing and financing?
So I think, again, if you look at this in sort of like a moment in time, you can get distracted by that versus the evolution of private markets. If we were sitting here in 2000, when you launched the firm in '87, there would really be two aspects to private markets. There would be buyouts, which you and the co-founders were very pioneering in, and then there would be venture capital. So it was like the beginning of an enterprise and then part of a company going private. This trend for private capital has been in place for well over 20 years. If you went back to 2000, I think the stat is something like the company that took private capital, venture capital, went public within 3 years. Now it's 11 years. And all that's happened is over that period of time, systematically, private capital providers have demonstrated the ability to be the marginally more effective capital provider. Now, as it relates to the bank discussion, when you look at the liability structures of firms like Carlyle, our liability structures just suit this process better than the banks. And I think it's just a natural evolution of the ecosystem of finance. So we're $425 billion of assets. The largest portion of the platform is in credit across CLOs, private credit, opportunistic credit, and that capital is the most efficient capital that can be provided. Otherwise, the receivers of those capital would obviously go to the banks. And I think that dynamic is healthier because more sources of capital is just better for the capital ecosystem.
Okay, so private equity firms have investment committees. They have memos that come in. They're 500-page memos about why a deal is great or so forth. These memos are prepared by very young people that went to very good business schools or good colleges. But do we need all these people?
Like Rutgers.
Like Rutgers.
Yeah.
Do we need all these people anymore? Because why can't, with artificial intelligence, we just say, go to the artificial intelligence software and tell us whether it's a good deal or not? Is that going to happen where we just replace all our people with AI algorithms?
So, let me get to the end of the question later, and let me start with the beginning in terms of how we think about it at Carlyle. So from my perspective as the CEO, I am obsessed with use cases. So we think about AI and the application of AI or large language models through three lenses. The first lens is, how can we actually improve the performance of our portfolio companies? So around the globe, we have 1.3 million employees in all of these companies. How can we help those companies be more competitive and have some competitive advantage? The second way is, how can we actually make the investing decision smarter, better, faster, more effective? That's what you're asking about. And the third way is, just how can we run Carlyle better? And I say use cases because, you know, we could have a long discussion about, is there too much hype in AI, and how much of it is hype, how much is reality. I don't think those are mutually exclusive discussions, by the way. You can have lots of hype and lots of future reality. As an aside, by the way, a friend of mine, sorry to digress for a second, a friend of mine said to me, this has to be too much hype, because in his business they added 2 new partners and they went to do a photograph for the new team, and the photographer said, okay, everybody, on 3, NVIDIA. And so he said, okay, that's it. That's the signal for him. But there's no doubt you will have a change in how work is accomplished. I'm personally, again, showing my age, I think it's pretty good when 23, 24, and 25-year-olds actually do the work, write their own memos. But we are seeing very specific ways to free up people's ability to think more. But I don't see in Carlyle, which is 2,200 people, I don't see a vision where in several years we're going to be 500 people and AI is doing all the work.
Now, people today always want to say or think they want to change the world, to make the world a better place, and they want to do something that is uplifting and makes them feel that their time on the face of the earth has been useful. How is investing wealthy people's money and making a higher rate of return for them a useful use of one's time on the face of the earth? How do you justify what you do and what your firms do and all the firms like yours? Why is just making more money for relatively wealthy people a good thing to be doing?
Well, again, when I was referencing before the 30 years that I've really been in the business, capitalism, economic growth, economic development, over that time period, billions of people came out of poverty. And a lot of that is about globalization, it's about the efficient allocation of labor, it's about economic growth. And I don't think no one argues against growth. You have to want growth, you have to want efficient growth, you have to want fair growth. And I think for all the people in the room here that are helping wealthy people be wealthier, deploy their capital more efficiently, or those not so wealthy actually accumulate wealth, buy homes, do all those things, I think that is the argument. Now, you can't have everybody doing that. Some people have to be out there actually doing even more important things, like coming up with cures for cancer. And of course, there's a lot of capital that goes into that space of the market also. But I think the deployment of capital done in a way that adds to economic growth is easy to defend.
So as the CEO of Carlyle, you spend time in New York, Washington, all over the world. The time you spend in Washington, you've met with government officials from time to time. When you meet with members of Congress, do you find that an uplifting experience?
Yes. Yeah, I really struggled with being here because I had a chance to be on the Hill, and then I decided marginally this would be a better use of time.
Okay. Now, when you were growing up in New Jersey, your last name is Schwartz.
Yes.
So probably your ethnic identification was probably well known to many people, I assume. But now you spend time with me sometimes going to the Middle East and talking to people in the Gulf. Did you ever think when you were growing up you're going to spend a lot of time in Abu Dhabi, Dubai, Saudi Arabia, places like that?
No. I spent most of my time thinking, wow, if I could not be the guy cutting the lawn and I could own the landscape company, that would be great. No, I didn't. No, I had none of those visions. I think.
And how do you find that? Do you feel any discrimination when you go there, or you find it's as welcoming as any other place?
No, I think that in many respects, you can go there and the changes they're making systematically and very progressively. If you're in Abu Dhabi, there's a mosque, a temple, and a church, all side by side. It can actually be somewhat more inspiring than some of the tension that we see here in the U.S. So no, I never feel that.
Well, let's suppose a president of the United States said to you, a lot of Goldman people, or former Goldman people.
I'm sure it's obvious to everyone at this point, none of this has been planned or rehearsed. I just want to make sure everybody understands that.
So a lot of former Goldman people, Bob Rubin, John Whitehead, Hank Paulson, Steve Friedman, have gone into senior positions in the U.S. government at Treasury or State. So suppose the President of the United States called you and said, you were a senior person at Carlyle and Goldman, we'd like you to come in as Secretary of Treasury or the equivalent. Would you ever consider that?
I think it gets back to your earlier question. If you're privileged enough to be in one of these positions where you've had a lot of experience and exposed to a lot of different market cycles and you think you can actually have an impact, I think you have an obligation. Just like, everybody knows David's one of the great philanthropists in the United States and gives his time and his capital. He's leaving here to fly to DC because he's hosting an event tonight. What is it? You're giving scholarships to DC kids that some of the best in the high school. So I think you have to consider it. But right now, Carlyle is my priority, David. Don't get confused.
Good. Great. Okay. So let's suppose in the case of ESG, ESG is an acronym that's gotten beaten up a bit by some people, though some people, are great advocates of it. How does Carlyle and the private equity world generally look at ESG? Do you have to make all of your companies ESG friendly, or do you think it's been overhyped and you don't have to worry about it so much?
So I think we have an obligation to our partners, our investors, all of our constituencies, our employees, and our shareholders to operate ourselves in a very conscious, thoughtful way. At the same time, we have to deliver returns. And so we have, led by someone named Meg Starr, who now has a much bigger role, but I think probably one of the best ESG teams in the industry. And they have developed a policy that we call, for example, we invest, we don't divest. And this kind of gets to the core of, I think, part of your question. And so, 80% of the world gets its energy from carbon sources. Whether you believe in climate change or you don't believe in climate change, obviously there's a need to have cleaner alternatives for fuel than 80% carbon. But we have taken a tactic, very much led by this team, that by investing in industries and helping them decarbonize, we're having the greatest impact. And so we really think about, at the margin, how can we have the greatest impact? And when it comes to other aspects of ESG, whether it's diversity, I personally am quite passionate that you have to have diversity of opinion, because teamwork is really what allows for operational creativity and solutions. And a bunch of guys that look like you and me sitting around a room may not be that creative.
So early in your career, before you had a college degree, you were a bouncer at a nightclub.
Technically during college also, just to be, yeah.
All right, so you're a bouncer, you're a big guy, so is it harder to be a bouncer and more dangerous, or is it harder to, and more dangerous to fire people when you have to call them in your office and say, you've been a good person, but you're gone? Which is harder, bouncing people out of a nightclub or basically firing people?
It's unclear. It's circumstance specific. Generally, as a bouncer, you have a lot of other bouncers around you. If you're unfortunately in a situation where you're separating from an employee, maybe you have someone from HR, maybe they're sort of diminutive, they're not big and brawny. I'm going to go with bouncing, more dangerous.
Okay.
Yeah.
So today, what is the greatest pleasure of running a publicly traded private equity, private credit firm? Is it you get to see anybody in the world, you get to make money? What do you actually enjoy about it, and why do you think it's a worthwhile endeavor for you to be spending your time doing?
So I think that, well, first of all, it's an incredible privilege, all those things you listed, obviously, I get to do, and who really gets to do that. And so I think the greatest satisfaction is when we're working on a complex situation. Could be something in the portfolio, could be acquiring an asset, could be solving a client's problem. I think it's when the team comes together and we can come up with differentiated solutions and really perform and win as a team, it's hugely satisfying for me. I've had the privilege of working with some of the best people on Wall Street for 30 years, and so that, I would say, by far is the most challenging, and seeing people's careers grow, right? As people evolve, and if you're fortunate enough to be the leader and you see them grow even from being analysts to much more senior in an organization, there's a lot of satisfaction in that.
So many people are obsessed with who the next president of the United States is going to be. Do you think it makes that much difference for the private equity, private credit world if one person is president versus another person?
Well, I think more broadly for markets, I think it's 23, there have been 23 elections since the S&P 500 was formed. In any year where there's a Democratic incumbent, the stock market goes up. I think it goes up something like, I'm going to get these numbers slightly wrong, anybody who's on chat or anything. I think it goes up 11% if a Democrat wins, 12% if a Republican wins. Right. I think that specifically the narrow answer to your question is, I don't think it actually has a big influence in terms of private markets. I think the capital that we're providing at the margin is so critical to economic growth that I don't spend a lot of time thinking about it.
So if you could only have one magazine with you on an island.
Forbes.
Would Forbes be the magazine?
Forbes.
That's it. That's the right answer. Okay. Thank you very much. Harvey?
Thanks, everybody.
Okay. Thanks a lot. Thanks a lot.
Great to be here. Have a good conference. Thank you.